Ever wonder why professional options traders rarely hold their positions until expiration? When you sell a credit spread, it is incredibly tempting to try and keep every single dollar of that premium. If you collect $100, you want the full $100. But mathematically, holding out for that last 50% is one of the biggest traps in retail trading. Today, we are breaking down why managing your credit spreads at exactly 50% maximum profit is the optimal strategy to grow your account. Let's look at how a standard credit spread behaves over time. When you open a position, say 45 days to expiration, you are relying on time decay to melt away the value of the options you sold. In the beginning, that decay moves slowly. But if the market moves in your direction, you can often hit 50% of your maximum profit within the first 2 weeks. Think about what that means. You just captured half of your maximum potential reward in only a fraction of the total time. If you decide to stay in the trade to collect the remaining 50%, the math completely shifts against you. You have to keep your capital locked up and exposed to market risk for another 3 or 4 weeks just to squeeze out the leftover change. You are staying in the market longer to make significantly less money per day. Essentially, you're taking a high probability trade and turning it into a low reward grind. More importantly, holding onto a spread for too long introduces massive risk. The closer you get to expiration, the more sensitive your options become to sudden, volatile price swings. This is driven by a metric known as gamma risk. Early in the trade, a sharp move against you is manageable, but in the final days before expiration, that cushion disappears. A winning trade that was up 80% on Tuesday can turn into a maximum loss by Friday morning because of a single bad headline or an unexpected midday market reversal. You are risking 100% of your collateral for a tiny sliver of remaining profit. Why take that risk when you don't have to? You can completely eliminate this nightmare by automating your exit strategy. By placing a mechanical limit order to buy back your spread the moment it hits 50% profit, you completely change your trading metrics. First, you drastically increase your overall win rate. You exit the market while you're ahead, avoiding late-stage reversals and keeping your emotions entirely out of the equation. Second, you speed up your capital efficiency. You free up your buying power early, allowing you to take that cash and immediately deploy it into a brand new 45-day to expiration trade with fresh, high-value premium. Over a full trading year, compounding these quick 50% wins will generate far more profit than waiting around for a few extra pennies at expiration. Trading options isn't about squeezing out every last cent. It's about repeating a mechanical, high probability process over and over again. Take your 50%, lock in the win, and move on to the next trade. That's it for today, traders. I hope you find this video valuable. If you did, hit the subscribe button and turn on notifications so you will never miss an update. Write a comment or thought about this video and what you would like to see next. Your support means the world to us. See you in the next one.